Welcome to Finance for World. I am absolutely thrilled you're tuning in today because we're going to dive into an explainer that breaks down one of the most fascinating and honestly volatile periods in recent financial history. Right now, looking at May 2026, global financial markets are caught in this massive, high-stakes tug of war. We've got these incredible, record-breaking forces pulling the global economy in completely opposite directions. It's creating this wild landscape where you can literally see certain sectors rocketing upwards while others are being dragged straight down. It really all boils down to one core question. What happens when an unstoppable tech boom meets immovable global inflation? Think of it like a giant rope. On one side, we have absolute euphoria surrounding artificial intelligence and technology. They're pulling hard. But on the exact opposite side, we have serious geopolitical drag and incredibly sticky inflation pulling right back. Today's market is caught squarely in the middle of this battle, and we're going to explore exactly how this is playing out across the globe. Okay, let's dive into this. Here is our agenda for the explainer today. 1. The grand market tug-of-war. 2. Tech and crypto surge upward. 3. Geopolitics and oil create drag. 4. Central banks hold the line. 5. Emerging markets feel the split. And finally, 6. Which market force will win? Section 1. The grand market tug-of-war. Right now, we're essentially living in a split reality. Over on the optimistic side, there's AI euphoria. We're talking massive earnings momentum, wild tech sector rallies, and steady, relentless crypto accumulation. But pulling in the exact opposite direction, we have intense macro uncertainty. We're dealing with sticky inflation, wildly fluctuating oil prices, and really serious geopolitical risks. Because these two dueling forces are hitting the markets at the exact same time, overall benchmarks, like India's Sensex and Nifty, are actually staying relatively flat. They're edging just slightly lower. The massive gains in certain areas are being completely canceled out by heavy losses in others. So at the index level, it looks like a stalemate. But beneath the surface, specific sectors are seeing wild, whiplash-inducing swings. Section 2. Tech and crypto surge upward. The crucial number to understand this incredible upward momentum is $81.62 billion. Let that sink in for a second. That is the massive first quarter revenue figure just reported by Nvidia. We're talking about a number so large it literally rivals the GDP of some entire countries. This figure easily smashed Wall Street estimates. Right now, Nvidia is acting as the central engine driving global tech optimism. Their upbeat sales forecast is signaling persistent, massive AI demand, and that's the fundamental reason why the optimistic side of our market tug-of-war is pulling so incredibly hard. And you know, that tech optimism is bleeding directly into digital assets. Bitcoin recently made an aggressive rebound toward the $77,934 mark. What's really fascinating here is that Bitcoin managed to shake off a volatile sell-off and more than $2 billion in ETF outflows. How? Well, it comes down to steady buyer accumulation and a massive improvement in global risk appetite that was directly sparked by Nvidia's strong earnings. Basically, the deep confidence in the tech sector is providing a very solid floor for crypto. And hey, this isn't just an American phenomenon. Nvidia's upbeat forecast acted as a global catalyst. Just look at the ripple effects across the world. South Korea's Kospi index jumped, driven by an 8.5% surge in Samsung Electronics after they successfully averted a workers' strike. Over in Taiwan, tech shares gained over 3%. SoftBank rallied hard on AI momentum and reports of potential IPOs. And across the crypto board, major altcoins like Solana and BNB saw really strong gains. The tech side of the rope is pulling with incredible synchronized strength globally. Now, what's really interesting is how things shift in Section 3. Geopolitics and oil create drag. To understand this heavy drag, we just need to look at the fragile U.S.-Iran peace talks. They're acting as a massive roller coaster for global energy markets right now. When reports came out that Washington and Tehran were in the final stages of negotiations, West Texas Intermediate crude dropped by nearly $10, down to $98 a barrel. The market was eagerly pricing in a reopening of the Strait of Hormuz. But then the situation shifted incredibly fast. Following a directive from Iran's supreme leader to halt the export of near-weapons-grade uranium, uncertainty just flooded right back in. Brent crude rebounded sharply, shooting above $106 a barrel. So we're seeing rapid geopolitical shifts instantly whipping oil prices back and forth. And those volatile energy costs, they aren't just staying neatly contained in the energy sector. They're bleeding directly into the broader economy. That brings us to 6.0%. That's the unexpectedly hot U.S. Producer Price Index, or PPI. Now, PPI measures the inflation businesses feel before they pass those costs on to us, the consumers. The expectations were sitting at 5.0%. But because wholesale energy prices spiked roughly 22% from a year earlier, inflation is proving to be incredibly sticky. This heavy anchor of energy costs is keeping inflation elevated, and it's pulling really hard against all that upward market momentum we just talked about. Section 4. Central banks hold the line. Over in the United States, incoming Fed Chair Kevin Warsh is stepping into a highly complex, divided situation. He's inheriting a split Federal Open Market Committee. That's the group responsible for setting U.S. interest rates. Because inflation is running so hot, mostly driven by those energy shocks we just looked at, markets have essentially priced out any prospect of near-term rate cuts. In fact, some committee members are even signaling that the next move could actually be a rate hike if above-target inflation becomes entrenched. And major players across the globe are moving in absolute lockstep to hold rates flat. The European Central Bank unanimously decided to keep their main refinancing rate steady at 2.15%. Similarly, the Reserve Bank of India held their key repo rate totally unchanged at 5.25%. They're all adopting a very tense wait-and-see approach. They're carefully assessing the impact of Middle East tensions on economic growth before making any sudden moves. Essentially, they're acting as the referees, holding the rope tight right in the middle of all this chaos. Let's move to and see how this builds in Section 5. Emerging markets feel the split. This contrast perfectly highlights the massive split we're seeing in global economies. Just compare South Korea to Indonesia. South Korea is heavily exposed to the tech boom. Because of that, their Kospi index jumped 8.5%, riding the massive wave of the chip sector. But look at Indonesia. They're heavily exposed to energy pressures from the Middle East conflict. Their stocks fell 3.4%. The rupiah weakened significantly against the dollar, and their central bank was forced into a surprise 50 basis point rate hike. That's a massive 0.5% jump just to defend their economy against those surging oil prices. It's the exact same global market, but two completely different realities. We also see this distinct split in the inflation data. As we touched on earlier, U.S. wholesale inflation ran uncomfortably hot at 6.0%, which was well above the 5.0% expectation. But look at India's consumer price index. It came in at 3.48%, actually dropping below the market expectation of 3.8%. Now, even though food inflation there rose slightly, consumer prices for transportation refrained from increasing. This was largely buffered by India's incredibly strong domestic fundamentals and an updated consumer basket. It just goes to show that domestic resilience can absolutely still provide a shield against global macroeconomic headwinds. Section 6. Which market force will win? To get a real sense of where we might be heading, let's look at a pretty stark quote from Francesco Pasole, an FX strategist at ING. He points out, markets are trying to de-trade a U.S.-Iran peace deal. Conviction is lower this time. Rhetoric from both sides remains belligerent. This is absolutely crucial. It emphasizes that the market is beginning to seriously doubt a rapid geopolitical resolution. And what that means is the heavy drag of elevated oil prices and the sticky inflation that comes right along with it might be sticking around for the foreseeable future. So I want to leave you with a provocative thought as we wrap up today's explainer. Will the incredible, record-breaking gravitational pull of AI and tech be enough to overcome the heavy, persistent drag of global inflation and geopolitical uncertainty? Ultimately, which side of this great market tug-of-war is going to determine the rest of 2026? It is a truly fascinating standoff, and it's one we are going to be watching incredibly closely. Thank you so much for joining me. Keep your eyes on these converging forces, and as always, stay curious.